Good morning, everyone, and thank you. Good morning, good afternoon, good evening. Thank you for joining in today. I'm Giuseppe Basile. I'll be the host of this presentation, which is part of the One Day, One Topic order flow. And as you know, my focus is mainly on algorithms and trying to observe the price patterns that algorithms that govern modern markets actually bring around. I believe there is a connection between order flow and algorithms, and today I'm going to show that to you. So the presentation is going to be structured as follows. There'll be an introduction of what order flow is a review of some definitions, and I will also show a couple of ways order flow is analyzed. Now, analyzing order flow, it's can be quite complicated because, as I'm going to show you, modern markets do not allow easily for price transparency, which is what we want, right? If we want to take advantage of the order flow that we believe is going to be present in the market, we need to have a way to understand exactly which kind of orders are hitting, are about to hit, or have or are in the market book. But this, as I'm going to show you, is not always possible. And then I'll start introducing the relation that I see between order flow and some families of algorithms. Now, modern markets are dominated by algorithms, as I'm going to show to you. And I will close the presentation with a quick reality check of what there is out there, some of the families and classes of algorithms, and which one of these families and algorithms can be exploited, and what we cannot exploit due to the fact that it's actually some of these algorithms actually are too quick, too fast for us. And then we will have a Q&A session. Risk management, as usual, it's number one. You can use any technique, including order flow, to trade, but you have to remember that when the money is gone, the game is over. Risk is everything. I have a rule, PPC, which is my rule number one: protect precious capital. And if you are watching the recording, stop your recording now and read this slide. Before I proceed, I also want to thank FS Street for inviting me, Adinda and Vicky for organizing this presentation, and thank you guys. You're fantastic as usual. So just a couple of lines about me. Started in 2001. I'm a computer science engineer, and I also have a master's in finance, and became CMT in 2012, certified CMT. And I'm also associated with the International Federation of Tech Analysts, for which I've wrote a few research paper in the last 3 years. As I mentioned, I started in 2001, but committed to research in 2003 and understood the importance of mentoring in 2006. And then I started working with a number of people: Vantar, Pivica, Juracic, Dier Barton, David Asley, Jody Napoli, and others. In 2009, I added 7,000 hours of screen time. I traded full time, and overall I have more than 17,000 hours of market exposure. I'm a swing trader at the moment. I don't look at the market all the time. In 2014, I launched Fibs Talker, and I have a Fibs Talker method coaching program going on. I'm enrolling now for the third session. And if you want to understand a little bit my approach, you can go to fibstalker.com, and there's a free newsletter you can subscribe there. So let's get into this. What is order flow? In order to define order flow, what we need to do, we need to understand which type of trading and which type of orders we are trying to analyze. Now, if as a retail traders and most speculator, we are interested in directional trading. What is that? That is about taking a position long or short, betting that the price will actually move either up or down. And we do that when we believe that a forex pair, or any financial instrument can actually continue higher or lower. But of course, I mean, in forex especially, there are a lot of players, different players, which actually have an effect on market which is much larger than what we can have as retail traders. For example, commercial banks, they do a lot of risk hedging, which means that they actually take the other side of position when clients ask for currency. If I am an American company and I need to trade with Canada, I will need Canadian dollars. So I go to one of these commercial banks and ask for $1 million in Canadian dollars, and the commercial bank on the other side will lend me the money, and will need to manage the risk. But these days, modern markets are totally different, and there are algorithms, and I'll show you the volume later on, that do a combination of directional trading. There are some classes that do that. And there are a lot of very short-term type of algorithms like ETF, which mainly do liquidity sourcing. Liquidity sourcing is also needed by institutions to execute large orders. So an order flow, it's really a flow of transaction, and it can occur then for disparate reason, as I just showed you. And it can be initiated by a different number of agents. They can be human agents, but they can be algorithms as well. I'm going to show you, what's the effect of algorithm, and can also be executed with a mixed type of orders, like market orders and limit orders as well. So what is order flow trading then? For price to move, we need orders to be executed so that they can consume liquidity at the best bid offer. And that's really the way the market works. The market is an action. Our representation of a market is given typically on charts, but that's just one of the representation of the market. Another a representation of the market is the market book, which its depth, the price level, and the quantity of bid and offer in each level. So order flow trading, then, it's about predicting the future order flow, the future transaction flow, and I just defined that will be generated in the future. So we can position ourselves to take advantage of that order flow, which we assume is going to move the market. So the point here, the key word here is the word assuming. So first of all, do we have all the information, or do we assume we have all the information? What I mean with all the information, do we have a representation of the order flow that is about to hit the market if we want to take advantage of it? Do we have a clear understanding of it? And what's our edge in doing that? Remember that we are competing against companies equipped with tools and PhD wizards, and they have direct market access. So that can be quite challenging. And again, we need to predict the order flow. So what's the predictive process? Are we being realistic? Is it complex? Is it simple? Can we do it as retail traders? So, and this leads me to talk about a little bit price transparency. What is that? Do we have access? Can we see the information related to the order flow for a particular financial instruments? And this could be forex, stock, could be a bond, a future. is that information really accessible? And also the depth of the market book that I mentioned before, and the quantities that are offered and bid at each price level, are they known? Are they visible? So to me, modern market is not really very transparent, and this is related to market fragmentation, the fact that trading happens on different electronic venues these days. Think of OTC forex, or the way the forex market is structured, but also the other markets, stocks, futures. So uh, I could actually claim or say or argue that exchanges and operators closely guard all their placement information. So it's not something that it's easily and readily available. And can we use depth of market too? I mean, if we had full access to the market book, would that actually help us? And what about the dark pools where some of the volume is traded? What about hidden stop orders, and even limit orders that are not they are not visible in certain electronic venues? And what about iceberg orders? Whereas a big institution that does execute a big order puts in a big order, 100 units or 100 shares or 100 lots per time, or less actually. So, and what about the orders that are executed by a mix of, program trading based type of algorithms that also use very, very short term strategies for liquidity sourcing? So actually, the situation is actually quite complex, and we might not be able to look at or have it really have information on price. So I don't believe modern markets are particularly transparent when it comes to price. So if we cannot actually rely on price to and actually information from the exchanges to study order flow, which kind of analysis we have to do? Maybe we have to turn and focus on something different, look at the different variables and market structure that we have out there. Maybe we could actually do different, think about different scenarios as well. Think about how the different market players, the large market players, those that can generate who can generate actually large orders, are positioned. And what about emotions? And here we get into something that is not very easy to actually understand and analyze. But we can think about aggregated emotions. We can think about market psychology, which is the aggregated behavior of traders taken as a group. That's something that it's much easier to model, and I'm going to show you some examples. What about the expectations of these players, and way more? So are all these things and aspects that we can analyze sufficient to identify the flow that can be generated to move price? Well, this for me is a very complex type of analysis. I don't know how you approach the market, but the way I approach the market is in a very step-by-step, well-defined, clear way, and doing an analysis like this would actually not allow me to have an actionable plan. So is the analysis that we need a kind of mental scenario planning? Believe it or not, and this is a type of trading technique, a trading concept, and it actually related to very discretionary systems, and probably requires the highest level of access to insider information, knowing what's going on, and typically is supported also by strong fundamental analysis. Now, mental scenario planning is specifically about understanding what's going on around in the world, and also information and rules that exist outside the trading game. So when we look at price, to understand this, when we look at price, we are really looking at information that is generated within the trading game. When we are looking at fundamentals, so we are looking at the reasons why a big order could be generated, we are looking really at information outside the trading game. So specifically, mental scenario planning requires an understanding of the big picture, what's going on around in the market and in the world, and the relationship between these things, and also observe and measure what is actually happening, and how we can find good profit opportunities. So I'm just trying to understand here if to do order flow analysis, we need to do something similar to mental scenario planning. Some people, on the other hand, speak about metagaming. What is that? A game within the game. Now, this part of the presentation might look a little bit abstract, but stick with me because I'm going to get, as usual, I have a very practical approach, and I'm going to get into the real trading and information and how we leverage this information. So a game within the game based on information that exists outside the game. That's a definition of metagaming. And it's really about exploiting our knowledge that we have of other players so that we can gain a strategic advantage, and actually we can trade and we can take advantage also of order flow. Now, who are these other players? And that's the question that I have for you. So who are these opponents, and how do we anticipate the choices? In a game like trading, where there is no structure and there are so many degrees of freedom. So observation of price structure, and I'm getting into it, to me, micro and macro is the key in modern markets that are dominated by algorithmic trading. And the fact that there is a lot of algorithmic trading out there, it's actually a way, and it's actually a kind of participation that we have to relate to, because our opponents might not really be humans, but they might be algorithms, as I'm going to show you in 1 minute. So again, who are they? How can we develop an intimate understanding of the way participants, and here I'm starting specifying here people and algos, and actually I'm going to show you algos are overwhelmingly more than human players in modern markets. So how can we understand how both human and algos and algorithms and machine play the game? And now, even if the market can be played in an infinite variety of ways, and the reason for this, think about it, but you can do anything in the market. You can go and buy, you can go sell, you can go anytime. You are not restricted. Yes, you are restricted from the capital you have as a retail trader, but generally there are very few restrictions. And also in terms of things that you can do, you can buy, you can sell. You can have a different position size for your position. So there are so many, possibilities. And still, most players consistently employ a finite number of elementary strategies. Is that possible? Yes, it is. Not only is it possible, but also algorithms and some families of algorithms that trade in modern markets use a finite number of elementary strategies. And this is important, and you can use that as an edge. And we can actually reconnect the observation we do on these algorithms to order flow. So how do we know that algorithms use a small number of elementary strategies? Before I answer this question, let me show you the reality of modern markets. So before I continue, do you have any question? Let me just stop 1 second, and please write down if you have any question. I'll leave you just a few seconds here. Okay, no questions there, so I'll just continue. If you have any question at any time, anytime, please write it down. So how we will find out our order flow? Will you tell about charts? Yes, I'm going to tell how I look at levels of order flow. In the end, in order to trade order flow effectively, we have to pick levels, and I'm going to tell I'm going to talk about that later on. And I'm going to show up as a simple example as well. Okay, so the answer is yes. But follow me. This is a very important introduction about what order flow is and how I get advantage of it. Okay, and the things I do in the end are very, very simple compared to the activity, the analysis activity that normally order flow would require. So now let's look at the reality of modern markets. The numbers of and volumes of algorithms are so relevant they cannot be dismissed or just ignored. Okay. And let's look at the volumes. Over 80% of participation of algorithms in major futures market, and this is an estimate of 2009. In 2014, this number could actually be 90% or more. Forex market, which is what you are most interested in it is more than 45% in 2010-2014. I'm talking about here about volume that is traded by algorithms in these markets. Options, 2010 was 20%, is much higher now. High frequency trading, and everybody is talking about it, is actually 35 to 75 of volume on the equity markets, European and American equity markets. I have a question here, what we mean with algorithms. Algorithms are automated agents, and they are automated using computers attached directly to the exchanges that execute some trading strategies. And so they create automatically buy and sell orders. That's the simplest definition. So they use computers and networks, so technical infrastructure, computer infrastructure to execute orders in the market. So as you can see here, Samsud, 80%. The volumes are very high of which kind of volume these algorithms trade. Okay, so and I was talking about high frequency trading between 35% and 75% of the time. So these are the sources. So the reality numbers are so relevant that cannot be dismissed or ignored. The proof of existence of families of algorithms is impressive. I'm going to show you later on. So I have another question here. Any idea how much is the algo trading percentage for Forex? I just gave that to you. It was 45% in 2010. Today it could be 50% or more. Why algorithms implement simple and elementary rules? Well, you hear a lot. These are my reasons. You hear a lot about high frequency trading, HFT. But you don't hear about other classes of algorithms. Why is that? I believe there are other classes of algorithms that are equally, if not more powerful than high frequency trading. But there's a lot of talking about high frequency trading. It's not maybe because, for the reason I wrote here, that as they are very powerful and can be exploited by retail, they go under the radar. There are other reasons why we don't hear about algorithms. Algorithms also have to source liquidity in high volume market, which means that for an algorithm to take a position, there has to be someone else that take the opposite position. Now, if the volume is skewed mainly towards algorithms trading in the market, actually they also have to pay other players with negative emotional states. What I mean is that if an algorithm has to enter in a spot, in that spot there have to be a lot of human players as well, who actually are in pain because they are ill positioned in the market and they're going to exit. HFT stands for high frequency trading, and it's a class of algorithms that is very, very quick and tries to get an advantage on the market using execution, very, very fast execution. Now, the reason why algorithms also implement simple and elementary rules is that I can prove you, and I'm going to prove you in the next example, that they can be effectively modeled using very simple rules. And this modeling that we're going to do offers an edge in trading the market. So the rules we use to model what algorithms are doing in the market are very, very simple. And most importantly, algorithms have internalized market psychology. What that means, the rules that we use to model algorithms have proven to work when we apply to the last 115 years of market data. So when we apply this to the Dow Jones first, and then the SP 443 and SP 500, and so on, to our modern and current markets. And if you want to prove of that, you can go back to the archive in FX Street and look at this presentation here on June 2019, June 2014, June 19 here, how Secretive Program Trading incorporates market psychology. In that presentation, I showed how applying the same rules that I'm going to apply now in an example, you actually can explain market price. You can explain the low in 1987 after the crash, the low in 1972, and you can explain also the low 667 in the SP 500 that we had in March 2009, and there is also an explanation of why I am looking for 2500 as the target for the SP 500 before we could actually get a sizable retrace. So finally, if we have to, order flow requires that we pick level. If we don't have information, then we need to pick level. There's a comment here from Fib Trader who says high frequency trading which you can ignore because you can do nothing about. That's exactly it, and I'm going to show this later on. So how do we pick levels? If you have to, as traders, when we want to trade the order flow, we need to anticipate that our order flow at some level. We have to pick a level, and that's one of the reasons it's a cornerstone of order flow in anticipating price. So we want to anticipate where big players have pending orders or will enter the market. So picking level is clearly important, and the orders we are interested in, the participants we are interested in are those large, very important participants with very large orders as well, because that's what can move the market. So order flow as retail traders cannot be traded without picking a levels. And the problem is that, and this is on one side is a problem because it scares out a lot of people because they don't know how to pick the levels. And on the other side, push people to trade what they see and not what they think, which is a good thing, actually. The problem is that very often, people actually revert to what they visually see on the chart, the only information that they can see, what they can actually, the patterns that they can visually identify in the market. So they typically use support and resistance formed at previous weekly, daily, and high. I have Samsung saying picking level. Samsung, if we want to enter the market, we need to pick a level where we enter the market, where we go long or short. Okay, so if we believe that there is price, that there is participation coming in the euro dollar at 121.25, we need to, that's our level. We need to act around that level. I'm going to show you how we act around the levels like those. Now, I don't choose to pick levels previous highs and lows. I believe that's a simplistic representation of where algorithms are located, because I look at effects on algorithms, effects on price due to algorithms. I don't look at this information. So how can we then use algorithms at our advantage to pick the levels? And that's, we're getting into how I look at the market. So the way I look at the market is, once I have identified a level, and there can be very simple ways of identifying levels. Let's suppose that we have a move from, try to annotate this. Let's suppose that we have a move from A to B, and this is just a schematic. Then we'll get into an actual example. So we have the market moving from this point here to a point here, and typically what can happen, that's only one of the patterns, right? We can see price retracing into the 50% of the move between A and B, and this 50% I represent here with a blue line here. And that's the example here, the market moving from A to B and then retracing into C. Okay, this is one simple pattern. So to me, what I'm saying here is that I'm anticipating order flow coming into the C level. Okay, and this is only one of the patterns that we use, and only one of the patterns we can use to model algorithmic effect on price. And actually, when that happens and you see participation here, you see a move higher here, you know that order flow is present there, and it's actually entering the market. And that's what you need after a retrace in order to get involved. The point is, if, as I showed you before, algorithms exist in the market, and that's a true thing, that there is a proof of that. But also, some classes of algorithms that are very, very powerful also exist on all time frames. So if you think about it, if algorithms exist on all time frames, also exist into this counter trend from B to C, and if we can study the sequence of measure move and the effects and participation of the algorithms in this smaller time frame, maybe we can get an edge on how to actually confirm the order flow that is coming in at C. And that's the main concept of it. So let's look at this example in more detail, and then I'm going to show you a real example on the New Zealand dollar versus the US dollar. Suppose we have a retrace into C here. What we do, the way these levels C are identified is important too, because what we want to study the presence of algorithms on this counter move from B to C, and we know that we can do that because algorithms exist on all time frames. So what we do then, we apply our rules to model price and model algorithms on this smaller time frame, and when the sequence of this measure move that can be identified fails after the level C has been tested, then let me see if I can annotate this. I cannot, but after the level C has been tested, if the sequence of measure move that models this move lower actually fails, then we can assume that the participation in C is stronger than the participation that we see on the other side, on the smaller time frame, that brings price into level C. So as you can see here, when we speak about order flow, we usually focus on this level here, the C. But you have to remember that there is order flow also in the smaller, coming into the smaller time frame that is bringing this price into this level C. So there is really a balance of powers here, actually an opposition of powers. And of course, what we anticipate is that the larger time frame always wins. And the reason for that, we anticipate that does not happen all the time, That's what we anticipate, and the reason we anticipate that is because we know that on the larger time frame there is larger participation as well, larger orders and larger players. So imagine this being the daily time frame, and this being the 15-minute time frame. Okay, so we have price retracing into on the 15-minute time frame, and there is a sequence there, retracing into a daily level. Of course, the daily level is actually stronger. Now I have a question here. Binu say, but C is in the past. No, C is not in the past, Binu, because see, I trace this retraces 50% retraces after I see B, and I start tracing from A to B. If there is no higher price than B, I have that level well before all the rest happens. Okay. So I don't trace this out after the fact. I'm showing this to you now after the fact, but normally when I follow the market, I keep tracing from A to B the high, and then that level is identified. And if price gets into that level, then we are on and we are active. Okay, good question. So now, if you're able to track this sequence of measured move getting into C, and when we break that sequence of measured moves, that is for us a confirmation that the participation that we had at C is stronger than the participation that we get in the smaller time frame. And that's for me a confirmation that this C level is important. There is order flow. It is coming into the market. Now this timing B2C can also be done in a procedural way using a technique that I call fib stalking, and that's a proprietary timing technique that analyzes the sequence of measured moves. Now let's see. Let me make a real example here, and I'm going to use the same schematic, the same idea that I gave before in that schematic. So we have our A here, which is this level here. And again, to answer to Binu, when we see this market going higher, right, at some point the market is here. So I trace from this level to this level. The 50% is more or less here, but the market never gets into that. So then the market continues the highest, and then I trace from A to B, and eventually the market gets into this level here. And as you can see, there is participation 3 times here. Okay, and this is something very simple. This is a 50% level, nothing special really. Now let me show you all that concept that I mentioned before, and I'm going to focus on this section here of the chart. Now what I want to show you is that there is a sequence of measured move getting into this C level, and when the sequence of measured move fails, that's a confirmation for us that we need to get involved in this level. Okay, that's one of the way you can involve. There are some traders who actually try to get involved right at that level with a very tiny stop, and you can get very good trades like that. So I'll repeat once again, we have this 50% level here, which is a potential level of participation of algorithms. It's also a potential level where order flow can come in. Now, when the price gets into this level, what I want to do, I want to go into the smaller time frame and study the sequence of measured move that I have here. Because when that sequence of measured move fails, then it means that participation we are getting here is strong enough to make us continue higher. Okay, so let's focus on this, and I'm going to show you in the smaller time frame, which is the 4-hour time frame, this measure move here, and we have A to C. So this is the smaller time frame, is that measured move into the 50% level, and what I see here is something like this. Right now, this move here is not really important. This move here. What is important is that there is a sequence there, and there is the market. When I trace from A to B, there is participation in this C area, and price is getting into D and E. And when it gets into E, we are into that 50% level of the larger retracement. Okay, so by following the rules that I use to model program trading, I trace from B to F. And as you can see, initially, the market participates on the short side here. The next level where the market should continue lower gets participation. But what happens is that as the participation at the larger time frame is actually, we are here now. We are right here, right below this 50% level, within this area of potential participation in the market. Now, as there is participation getting into that market from the larger time frame, which identifies also the presence of order flow, what happens is that initially this market continues in the sequence of measure move shorts into that 50% level, as you can see here. But then this participation from the larger time frame actually pushes price higher beyond a level that indicates the violation of the sequence of measure move short. When that happens, it means that the people who are on this time frame, which is the 4-hour time frame, are no longer interested in actually pushing this price lower. Now, if you are on top of a 50% level or on any other level that is important for program trading, and the smaller time frame is not interested in keep pushing this price lower, what happens? It happens that any order flow that comes in is capable of bringing price higher. Okay, so that's one way I look at the effects of algorithms, and I link that back to order flow. Can you take live charts to explain, sir? I don't have them in this presentation. I can open it if we have time. Otherwise, you can just go Samsung to my website, and there are plenty of examples. I have plenty of examples there. If you subscribe to the free newsletter, I also send you the weekly review in which I use exactly the same pattern. So would you wait for retracement a few times before entering, or hop in the first one? I mean, in this specific case, there are different ways you can enter. In this case, you just hop on a breakout of this level, just one pip above. Okay, that would be one way of entering the market. Okay, there are other ways to enter the market as well with a more convenient price. So I just wanted to give you an example. We don't have a lot of time, so I want to close this up. And again, if you want to get examples of this kind of analysis, just go to my website, fibstalker.com, and there's a free newsletter. There are a lot of I have over than 500 videos in which I analyze the last 3 years in the markets, and you can get in the weekends you can get the review as well. It's a video that I record every week with exactly the same patterns. So now let me I want to conclude. So the website is this one, just in case, and I'll give it later on. But so let me close this, and I want to make a quick reality check here. First of all, there are a lot of and different several classes of algorithms in modern markets. High-frequency trading is one of them. There are also new high-frequency trading algorithms that source liquidity from other high-frequency trading algorithms. It's really a battle, a war between algorithms. Think about the latest version of Sniper or Guerrilla in 2011, which actually try to source liquidity, try to actually take the other side of the orders of HFT themselves. Now, HFT are faster and smarter, and orders can be executed in microseconds or even nanoseconds. So it's not really something that affects us, as Fib Trader was saying before. So there is no competition in that space. You can leave that away. Reality check number one: institutions run algorithms and have access to a significantly richer data set compared to what we can get as retail traders. Okay, so the most important thing, and I've just showed you an example, there are some families of algorithms that are slow enough. They're not HFT. I call them program trading. In reality, they are family of algorithms. They are a group of algorithms, okay? And they are slow enough, and they implement elementary strategies. If you go back to the example I just showed you, I used Fibonacci in a different way, and I have a number of rules, very, very simple, that I use to model algorithms in the market. So if that's the case, in this specific case, there is an opportunity for a trading edge if we learn to follow and to actually observe price effects of a classes of algorithms on the market. Number three, retail traders do not get in trouble because they don't understand order flow or algorithms. They actually get in trouble because they do not understand risk management. So again, risk management is paramount. And if you don't know anything about risk management, about position sizing, that's the first thing you should do. Okay, never without it. And a lot of traders, unfortunately, do without it. I have some statistics from Oanda, which is the largest North American broker, forex broker, one of the largest in the world. And his head of sales mentioned me that 22% of their clients, they never use stop loss, hard stop loss. And the totality of them, 100% of them, gets margin calls, which means that all their capital is wiped out. Okay, so don't let that happen to you. So number four, high frequency trading as an algorithms look for steady wins. Their models detect very high probability setups. And actually, the one that I showed you before is a very high probability setup as well, especially after you apply the procedure for confirmation. So they go in and out in a very mechanical way without emotions, and they take steady profits. And actually, there is one thing that I haven't showed you. Let me come back to that as well. Here I have a minus 23.6%, which is one of the targets that I use. And as you can see, after the market participates to, I want to annotate it if I can, but after the market participated in this area, 081.12, price gets into that level, and to the pip almost, there is profit taking. And then the price gets again into it, and there is another profit taking. And if you study this chart, I'm trying to annotate it again. Yes, if you study this chart, you will see that when you trade from this level to this level, the market came again into the 50% level and traded that successfully. So, just wanted to mention this. I'm going to complete this. I don't have a lot of time, and you can do that as well. So you can actually trade those levels in a very mechanical way, using and studying the effect of algorithms on price. And of course, you have to do that at the same time by managing risk properly. And when we have participation from a level, very often we can get a free risk trade. And if I have time, I'm going to explain that to you. So reality check number 5 is that program trading and high frequency trading know what they're doing, and for a very well researched reason. And sometimes, as I mentioned before, they have to source liquidity, and they do source liquidity knowing the psychology of the market, knowing the spots where people are in pain and want to exit, so that they get that additional liquidity. So there is no second guessing on their side. So there is an opportunity to piggyback their activities if you are able to identify what they're doing. Reality check number 6 is very likely that the counterparty of our trade is actually an algorithms, and also well-capitalized algorithms, well-informed. And I showed you that before, because more than 45%, probably more than 50% in Forex is algorithms, right? So these algorithms also are very, very informed. They also know very well the false TA signals, the moving average touches, the band trading, the Bollinger reaction. They know the late statistics, the late stochastics or RSI, all the reason why that provoke you to click that buy and sell. And in fact, 95% of retail traders lose money, right? So they know that very, very well. Reality check number 7, some families of algorithms trade trends in time frames until the trend comes to a completion, and then they reverse. And it might not look that simple to you, because then market is also expression of the what these algorithms are doing on all time frames, as well as external effects that come, for example, on the smaller time frame by high frequency trading or by news and so on. So some of these levels are very, very important also for price discovery. And I define price discovery in a slightly different way, which is really information that we can gather from price that can help us to understand what happens next. Price discovery typically is defined as price going to fish for new levels and new price levels in order to see whether there is participation. But we can do a different type of price discovery, trying to understand what happens when an algorithm fails one of those levels that I showed you before. You can establish how algos are likely to what they're likely to do next. Reality check number 8 is I've just this is my last slide. So reality check number 8 is the level of effort expended to develop all this electronic trading system market, which is dominated by algorithms. It's really staggering. So does that mean that that's game over, or it's a slam dunk? Why we compete then? The reality is that some families again can be actually leveraged, and an edge can be created because they cope with the need of liquidity sourcing. So they have to get that liquidity from somewhere. Okay, so there is still an hope and a great trading edge to learn. There is not a lot of time, as Linda is telling me that we ran out of time. If you want more information, just get to the blog and subscribe and the newsletter, and you'll get a lot of this information. And if you want to drop me an email, you can do that here. Thanks a lot for being here. I hope it was interesting, and I'll see you next time. The presentation will be in the archives. Thank you very much and have a great day.